Did you know that Elon Musk paid zero federal income tax in 2018? Jeff Bezos paid nothing in 2007 and 2011. And Warren Buffett? His tax rate is lower than his secretary's. While you're paying 20 to 30% of your income in taxes, billionaires are legally paying almost nothing. Today, I'm going to expose the 7 most powerful tax loopholes that the ultra-wealthy use to keep their money. Loopholes that are perfectly legal, but completely unknown to regular people. By the end of this video, you'll understand exactly how the rich play by a completely different set of rules, and why our tax system isn't broken. It's working exactly as designed. Let's dive in. Hey everyone, welcome back to the channel, and if you're new here, this channel is all about breaking down complex financial concepts that schools never taught you but the wealthy have known for generations. Now, before we start, I want to be crystal clear. I'm not encouraging tax evasion, which is illegal. Everything we're discussing today is legal strategies that exist within our current tax code. These aren't cheats, they're features of the system that most people simply don't know about. I've spent years studying tax law and financial planning, and I'm going to explain these concepts in simple terms using real-world analogies so anyone can understand them. Make sure to subscribe if you find this valuable, and let's get started with the first loophole. Carried interest loophole. The carried interest loophole is like being paid in magical money that gets taxed at a discount rate. Here's how it works. Imagine you're a fund manager at a private equity firm. Instead of getting paid a regular salary that would be taxed as ordinary income at rates up to 37%, you structure your compensation as carried interest. This means you get a percentage of the profits when investments do well. Think of it like this. If you were a regular employee flipping houses, your profits would be taxed as regular income. But if you're a fund manager doing the same thing with investor money, suddenly those profits become capital gains, taxed at only 20%. It's the same work, the same risk, the same profit, but a completely different tax rate just because of how the payment is structured. Private equity managers, hedge fund managers, and real estate fund managers use this loophole to save millions in taxes every year. They're essentially converting their salary into investment gains on paper, even though they're just being paid for their work. The carried interest loophole costs the US Treasury billions in lost revenue annually, while allowing some of the highest paid professionals in America to pay lower tax rates than middle-class workers. 1031 exchanges. The real estate swap, unquote. Let me tell you about Sarah, a real estate investor who bought a small apartment building for $500,000 10 years ago. Today, it's worth $1.2 million. If Sarah sells it, she'd owe capital gains tax on that $700,000 profit, about $140,000 in taxes. But Sarah is smart. Instead of selling, she does what's called a 1031 exchange. She finds another property worth $1.2 million and essentially trades her old building for the new one. No cash changes hands directly, but she ends up with a more valuable property. Here's the kicker. Because it's technically an exchange and not a sale, Sarah pays zero taxes on that $700,000 gain. She's basically reset the clock and can do this over and over again. Sarah just moved $700,000 in wealth without paying a dime in taxes. She can repeat this process indefinitely, building a real estate empire while the tax bill keeps getting pushed into the future. This is how real estate dynasties are built, not through earning money, but through smart swapping. Think of 1031 exchanges like a giant game of musical chairs with properties. As long as you keep moving from one property to another, you never have to sit down and pay the tax bill. The wealthy use this to build massive real estate portfolios, while keeping their money working instead of going to the IRS. Offshore accounts and shell companies. Offshore banking is like having a magic invisibility cloak for your money. Picture this. You create a company in the Cayman Islands, a place with no corporate income tax. This company technically owns your investments, your intellectual property, or your business profits. Since the company isn't American, it doesn't pay American taxes. Now, you might think, but won't I pay taxes when I bring the money back to the US? Here's where it gets clever. You don't bring it back as income. Instead, you have the offshore company lend you money. Loans aren't taxable income. So you're essentially lending yourself your own money, paying yourself back with interest, which is tax deductible, and the principal never gets taxed because it's not technically income. It's like having 2 bank accounts, one visible to the tax authorities and one that's legally invisible. Major corporations do this on a massive scale. They'll have a subsidiary in Ireland or Luxembourg that owns all their intellectual property, then pay licensing fees to use their patents and trademarks. Apple, for example, has used variations of this strategy to keep hundreds of billions in overseas profits largely untaxed for years. They're not breaking any laws, they're just playing the global tax arbitrage game better than anyone else. Trusts, the ultimate wealth preservation tool. Meet Robert, a tech entrepreneur worth $50 million. He knows that if he dies, his kids will owe estate taxes of up to 40% on anything above the exemption limit. That's potentially $20 million gone to taxes. So Robert sets up something called a Grantor Retained Annuity Trust, or GRAT. He puts $10 million worth of his company stock into this trust. The trust is designed to pay him back the $10 million plus a small interest rate over 10 years. But here's the magic. His company stock grows at 25% per year. By the end of 10 years, the trust has $10 million to pay back to Robert, but it also has an extra $40 million in growth. That $40 million goes to his kids completely tax-free. Robert just transferred $40 million to his children without paying a single dollar in gift or estate tax. He used the trust like a financial time machine, locking in today's value while passing future growth to the next generation. Trusts are like legal containers that can hold wealth and have their own special tax rules. There are dozens of different types. Some make your assets invisible to creditors, others let you control money you've technically given away, and some allow you to pay your family's taxes while they keep all the benefits. The ultra-wealthy don't just use one trust. They create whole networks of interconnected trusts, each serving a different purpose in their grand tax strategy.
Step up in basis. The death tax advantage. This might be the most unfair loophole in the entire tax code, and it rewards you for dying rich. Here's how it works. Let's say you bought Amazon stock for $100 per share 20 years ago, and now it's worth $3,000 per share. If you sell it while you're alive, you'd pay capital gains tax on $2,900 per share in profit. But if you die holding that stock, something magical happens. Your heirs inherit it at the current market value. $3,000 per share becomes their new basis. If they sell it the next day for $3,000, they owe zero taxes because they have no gain. It's like the tax code has a reset button that only works when you die. 20 years of gains just disappear for tax purposes. Think of it this way. The government essentially forgives all the taxes that would have been owed on a lifetime of investment gains just because someone held onto their assets until death. This is why Warren Buffett has held Berkshire Hathaway stock for decades instead of selling and diversifying. He's planning to pass those gains to charity and his heirs tax-free. Wealthy families build their entire investment strategy around this loophole. They buy assets young, hold them forever, and pass generational wealth that never gets taxed. It's how family dynasties maintain their wealth across generations. Charitable foundations. Doing good while avoiding taxes. Let me tell you about Michael, a successful entrepreneur who just sold his company for $100 million. He's looking at a massive tax bill and about $20 million in capital gains taxes. Instead of writing that check to the IRS, Michael does something clever. He donates $50 million of his company stock to a charitable foundation he creates, the Michael Family Foundation. This gives him a $50 million tax deduction, completely wiping out his tax liability. But here's where it gets interesting. Michael's wife becomes the foundation's executive director with a $200,000 salary. His kids get internships and eventually board positions. The foundation buys a nice office building, which the family can use for events, hires Michael's friends as consultants, and sponsors conferences in beautiful locations. Meanwhile, the foundation only has to give away 5% of its assets each year to maintain its tax-exempt status, so that $50 million keeps growing in the stock market, and Michael's family has effectively created a permanent tax-free piggy bank that they controlled. Michael just turned his tax bill into a family business. He avoided $10 million in taxes, created jobs for his family members, and built a legacy foundation, all while helping charity. It's like having your cake, eating it, and getting applause for your generosity. This is why so many billionaires pledge to give away their fortunes. They're not just being altruistic, they're creating sophisticated financial structures that benefit their families for generations while providing massive tax advantages. Tax loss. Harvesting, turning losses into wins. Tax loss harvesting is akin to alchemy, transforming investment losses into gains through clever timing. Here's the concept. Imagine you have two investments. Stock A has gained $50,000 and stock B has lost $50,000. If you sell stock A, you owe capital gains tax on $50,000. But if you sell both stocks on the same day, the $50,000 loss cancels out the $50,000 gain, and you owe zero taxes. But wealthy investors take this much further. They'll sell losing investments to harvest the tax losses, then immediately buy similar but not identical investments to maintain their market exposure. It's like getting a tax refund for picking some bad stocks. The really sophisticated version involves something called direct indexing. Instead of buying an index fund that owns 500 stocks, wealthy investors buy all 500 stocks individually. This allows them to sell individual losing stocks throughout the year while keeping the overall portfolio performance intact. Some wealthy families generate millions in artificial tax losses every year through complex strategies involving options, derivatives, and sophisticated trading algorithms. They're essentially manufacturing tax deductions from thin air while maintaining their desired investment exposure. Think of it as turning the volatility of the stock market into a tax advantage. Every market dip becomes an opportunity to create tax savings. So there you have it. 7 completely legal strategies that allow the ultra-wealthy to minimize their tax burden, while the rest of us pay full freight. The key insight here isn't that rich people are cheating. They're just playing by a different set of rules that most people don't even know exist. Our tax code isn't accidentally complex. It's designed this way to create opportunities for those with the knowledge and resources to exploit them. Here's the thing. Many of these strategies aren't exclusively for billionaires. Some can be scaled down for regular investors. The 1031 exchange works for anyone who owns investment property. Tax loss harvesting can benefit anyone with a taxable investment account. Even basic trust can help middle-class families pass wealth to their children more efficiently. The real secret isn't just knowing these loopholes exist. It's understanding that our entire tax system is built around incentivizing certain behaviors. The government wants people to invest in real estate, start businesses, and give to charity, so it created tax advantages to encourage these activities. The wealthy simply understand these incentives better and structure their entire financial lives around them. If this opened your eyes to how differently the tax game is played at the top, make sure to subscribe for more content that pulls back the curtain on how money works. Drop a comment below. Which loophole surprised you the most? Thanks for watching, and I'll see you in the next one.